Hey everyone, welcome back to Native Speakers Channel. I'm Johnny, and as always, I'm here with my good friend Sarah. Today, we've got a really practical topic for you, something you'll definitely use in real life. We're going to help you master money talk, specifically banking and money conversations. Whether you're opening a bank account, talking about your finances, or just discussing money with friends, we've got you covered. Sarah, are you ready to dive into some money talk?
Absolutely, Johnny. This is such an important topic. Money conversations can be tricky, even for native speakers, so we're going to break everything down for you step by step. Let's get started. So, Johnny, let's start with the basics. Imagine you've just moved to a new city and you need to open a bank account. What would you do first?
Great question. Well, the first thing I'd do is research different banks to see which one offers the best services for my needs. I'd look at things like monthly fees, interest rates, and whether they have convenient branch locations or good online banking options.
Exactly. And once you've chosen a bank, you'd need to actually go in and speak with a bank representative. Let's role play that conversation. I'll be the bank employee and you're the customer.
Sounds good. So I walk into the bank and approach the counter.
Good morning. Welcome to First National Bank. How can I help you today?
Good morning. I'm interested in opening a checking account. Could you tell me what options you have available?
Of course. We have several types of checking accounts. Our basic checking account has no monthly maintenance fee as long as you maintain a minimum balance of $500. We also have a premium checking account that offers interest on your balance and comes with additional perks like free cashier's checks and no ATM fees.
I see. What's the monthly fee for the premium account?
The premium account has a $15 monthly fee, but it's waived if you keep a minimum balance of $2,500 or if you have direct deposit set up.
Okay, I think the basic checking account would work better for me right now. What do I need to open one?
You'll need to provide two forms of identification, typically a driver's license or passport, plus another ID like a social security card or utility bill. You'll also need to make an initial deposit. For our basic checking account, the minimum opening deposit is just $25.
Perfect. I have all of those things with me. How long does the process take?
We can get you set up in about 15 to 20 minutes. I'll just need you to fill out this application form and then I'll process everything for you. You'll receive your debit card in the mail within 7 to 10 business days, and in the meantime, I can give you some temporary checks.
That sounds great. Let's go ahead and get started.
Okay, let's pause there and break down some of the key vocabulary we just used. Johnny, can you explain what a minimum balance is?
Sure. A minimum balance is the smallest amount of money you need to keep in your account to avoid fees or to qualify for certain benefits. For example, if a checking account requires a $500 minimum balance, you need to make sure your account never drops below that amount, or you might get charged a monthly fee.
Right. And what about direct deposit? That's a term that comes up a lot.
Direct deposit is when your employer automatically transfers your paycheck directly into your bank account instead of giving you a physical check. It's super convenient because you don't have to go to the bank to deposit your check. The money just shows up in your account on payday.
Exactly. Now, let's talk about some other common banking terms. What's the difference between a checking account and a savings account?
Great question. A checking account is designed for everyday transactions. You use it to pay bills, make purchases with your debit card, and withdraw cash. It's your main account for money that's coming in and going out regularly. A savings account, on the other hand, is meant for money you want to set aside and save for the future. It usually earns interest, which means the bank pays you a small percentage for keeping your money there.
And savings accounts typically have limits on how many withdrawals you can make per month, right?
Exactly. Many savings accounts limit you to 6 withdrawals per month. If you go over that limit, you might get charged a fee. The idea is to encourage you to save the money rather than spending it.
What about interest rates? Can you explain how those work?
Sure. An interest rate is the percentage of money the bank either pays you for keeping your money in a savings account or charges you if you borrow money through a loan or credit card. For example, if you have $1,000 in a savings account with a 2% annual interest rate, the bank would pay you about $20 over the course of a year. It's not much, but it's free money just for keeping your savings at that bank.
And on the flip side, if you have a credit card with a high interest rate, that's called an APR, annual percentage rate. If you don't pay off your credit card balance each month, you'll be charged interest on what you owe. That's so important to understand.
Credit card interest rates can be really high, sometimes 18, 20, or even 25%. That's why it's crucial to pay off your credit card bill in full every month if you can.
Now let's talk about some everyday banking transactions. Johnny, what are some things people commonly do at the bank?
Well, there are quite a few. One of the most common is making a deposit. That's when you put money into your account. You can deposit cash, checks, or even money orders.
Right, and how would you ask to make a deposit?
You might say something like, "I'd like to make a deposit to my checking account," or "I need to deposit this check." If you're using an ATM, you just select the deposit option on the screen.
What about withdrawals? How do those work?
A withdrawal is when you take money out of your account. You can do this at an ATM using your debit card, or you can go inside the bank and request a withdrawal from a teller. You might say, "I'd like to withdraw $200 from my savings account, please."
And if you need to move money between your own accounts, that's called a transfer, right?
Exactly. You might transfer money from your savings to your checking, or vice versa. You can usually do this online, through your bank's mobile app, at an ATM, or by speaking with a teller. You'd say something like, "I need to transfer $500 from my savings account to my checking account."
And what about when you need to send money to another person? What are the options for that?
There are several ways. One traditional method is to get a cashier's check or a money order. These are guaranteed forms of payment that are safer than personal checks. You might need one when you're making a large purchase, like buying a car or paying rent.
And nowadays, there are so many digital options too. You can use apps like Venmo, Zelle, PayPal, or Cash App to send money to friends and family instantly.
That's true. Wire transfers are another option, especially for larger amounts or international transactions. With a wire transfer, money is sent electronically from one bank account to another. It's fast, but usually comes with a fee.
Speaking of fees, let's talk about some common bank fees people should be aware of.
Good idea. One of the most common is the overdraft fee. This happens when you try to spend more money than you have in your account. If the bank allows the transaction to go through anyway, they'll charge you a fee, usually around $35.
That can add up really quickly if you're not careful. What's the best way to avoid overdraft fees?
The best way is to keep track of your balance and make sure you always know how much money you have available. Many banks offer overdraft protection, which links your checking account to your savings account or a line of credit. If you accidentally overdraft, money is automatically transferred to cover it, usually for a much smaller fee.
Another common fee is the ATM fee. If you use an ATM that doesn't belong to your bank, you might get charged twice, once by your own bank and once by the bank that owns the ATM.
Yeah, those fees can be $5 or $6 per transaction. The best way to avoid them is to only use ATMs that are part of your bank's network, or to get cash back when you make a purchase at a store.
Now, let's shift gears a bit and talk about how native speakers discuss money in casual, everyday situations. Money can be a sensitive topic, so it's important to know the right expressions and etiquette.
Absolutely. Let's start with something simple, splitting a bill at a restaurant. Sarah, imagine we just finished eating dinner with some friends. How would you suggest splitting the check?
I might say something like, "Should we split this evenly?" Or, "Do you want to just divide it equally among all of us?" If everyone ordered similar things, splitting evenly is the easiest option.
Right, but what if someone ordered something much more expensive, or maybe someone just had an appetizer while others had full meals?
Good point. In that case, you might say, "Why don't we each pay for what we ordered?" Or, "Should we do separate checks?" Some people will suggest, "Let's just figure out what each person owes."
And what if someone offers to pay for the whole meal?
Oh, that's nice. You might hear someone say, "This one's on me," or "Let me get this," or "I've got this covered." If someone offers to pay, it's polite to thank them, but maybe offered to get the next one. You could say, "Are you sure? Well, thank you so much. I'll get the next one."
What about tipping? That's something that varies a lot by culture. In the United States, tipping is expected in most service situations.
That's right. In restaurants, the standard tip is 15 to 20% of the total bill before tax. For really excellent service, you might tip 25% or more. For adequate service, 15% is acceptable, but anything less might be seen as indicating poor service.
And you'd never say tip is a verb in the present tense, right? You don't say, I'm tipping the waiter. Instead, you'd say, I'm leaving a tip, or I'm going to tip the server.
Exactly. Now, what about when friends lend money to each other? That can get awkward sometimes.
It definitely can. If you need to borrow money from a friend, you might say, hey, I'm a little short on cash right now. Could I borrow $20 until Friday? Or would you mind spotting me for lunch today? I'll pay you back tomorrow.
Spotting someone means covering their cost temporarily. That's great casual language. And if a friend asks to borrow money, you might say, "Sure, no problem," or "Yeah, I can lend you that."
But here's important etiquette. If you borrow money from a friend, pay it back as soon as you can. Don't make them ask for it. You should bring it up first and say something like, here's that $20 I owed you. Thanks again for helping me out.
Absolutely. Nothing damages friendships faster than money that's borrowed and never repaid. Now, what about discussing salaries? That's a topic that some people find uncomfortable.
In American culture, asking someone directly about their salary is generally considered rude or too personal, unless you're very close friends or discussing it in a professional context, like negotiating your own salary.
Right. You wouldn't typically ask a new acquaintance, "How much money do you make?" But among close friends, people might share that information, especially if they work in similar fields.
If the topic comes up and you don't want to share specific numbers, you can be vague. You might say, I make a decent salary, or I'm doing okay, or I make enough to live comfortably.
Let's talk about some more serious financial conversations, the kind you might have with a financial advisor or even with a spouse or family member when planning for the future.
This is really important stuff. Sarah, let's say someone is meeting with a financial advisor for the first time. What kinds of questions might they ask?
Great question. They might start by asking, "What should I be doing to plan for retirement?" Or "How much should I be saving each month?" Or "What's the best way to invest my money?"
And the advisor might respond with questions of their own to understand the person's situation. They might ask, what are your financial goals? Or what's your risk tolerance? Or do you have any debt that we need to address first?
Let's break down some of those terms. Risk tolerance refers to how much risk you're willing to take with your investments. Some people are comfortable with high-risk investments that could earn a lot of money, but could also lose money. Others prefer low-risk, stable investments.
Right. And financial goals are the things you're working towards financially. That might be buying a house, paying for your kids' college education, retiring comfortably, or building an emergency fund.
An emergency fund is so important. That's money you set aside for unexpected expenses, like if your car breaks down, you have a medical emergency, or you lose your job. Financial experts usually recommend having 3 to 6 months of living expenses saved in an emergency fund.
Let's talk about debt for a minute. There are different types of debt and some conversations people commonly have about managing it. Sarah, what would you say is the difference between good debt and bad debt?
That's a great distinction. Good debt is debt that's an investment in your future, like student loans for education or a mortgage for a house. These things can increase your earning potential or build equity. Bad debt is debt from things that lose value or don't generate returns, like credit card debt from buying clothes, electronics, or going out to eat.
Exactly. If someone is struggling with debt, they might have a conversation with a financial counselor about creating a repayment plan. The counselor might suggest the snowball method or the avalanche method.
Can you explain those?
Sure. The snowball method means paying off your smallest debts first while making minimum payments on larger debts. This gives you quick wins and motivation. The avalanche method means paying off debts with the highest interest rates first, which saves you more money in the long run.
Both strategies have their advantages. Now, what about credit scores? That's something everyone should understand.
Absolutely. Your credit score is a three-digit number that represents how trustworthy you are as a borrower. It typically ranges from 300 to 850. The higher your score, the better.
And your credit score affects so many things, whether you can get approved for a loan, what interest rate you'll pay, and sometimes even whether you can rent an apartment or get certain jobs.
Right. People often ask, how can I improve my credit score? Or what's hurting my credit? The main factors are paying your bills on time, keeping your credit card balances low, not opening too many new accounts at once, and having a longer credit history.
Before we wrap up, let's go over some common idioms and expressions related to money that native speakers use all the time.
Great idea. Let's start with break the bank. If something breaks the bank, it means it's very expensive or costs more than you can afford. For example, I'd love to go on that vacation, but it would break the bank right now.
Here's another one, strapped for cash or tight on money. Both of these mean you don't have much money at the moment. You might say, I can't go out for dinner tonight. I'm a bit strapped for cash.
What about making ends meet? This means earning just enough money to pay for your necessities. Since I lost my job, it's been really hard to make ends meet.
Living paycheck to paycheck is similar. It means you spend all of your paycheck before the next one comes, with nothing left to save. Most Americans are living paycheck to paycheck these days.
Here's a positive one, in the black. If a person or business is in the black, they're making a profit or have more money than debt. The opposite is in the red, which means losing money or being in debt.
Money doesn't grow on trees is something parents say to kids. It means money isn't unlimited and you have to work for it. You can't buy everything you want. Money doesn't grow on trees.
A penny saved is a penny earned means that saving money is just as important as earning it. It encourages people to be frugal and save.
And if someone is penny pinching, they're being extremely careful with money, sometimes to the point of being cheap. He's so penny pinching that he won't even buy coffee at a cafe.
On the flip side, if someone spends money like water, they spend it very freely without thinking about it. She spends money like water. She's always buying new clothes and gadgets.
Cost an arm and a leg means something is extremely expensive. That designer handbag costs an arm and a leg.
And finally, money talks means that people with money have power and influence. They approved his application right away. Money talks.
Wow, Johnny, we covered so much today. From opening bank accounts to casual conversations about splitting bills to financial planning and money idioms. This was comprehensive.
We really did. I hope everyone watching feels more confident about having money conversations in English now. Remember, these are skills you'll use throughout your life, so it's worth practicing.
Absolutely. And don't be afraid to make mistakes. Even native speakers sometimes fumble with money talk because it can be awkward or uncomfortable. The important thing is to communicate clearly and respectfully.
Great point, Sarah. Thanks so much for joining me today, everyone. If you found this lesson helpful, please give it a thumbs up, subscribe to Native Speakers channel, and let us know in the comments what topics you'd like us to cover next.
Yes, we love hearing from you. And remember, practice makes perfect, so try using some of these phrases and expressions in your everyday life. Good luck with your English learning journey.
See you next time on Native Speakers channel.
Bye, everyone!